What about the five most important staple factors which are important in any budget and every budget? For that, let's go to Supriya. Supriya?
Now that really sets the broad context of Budget 2018. But before we go any further, it's important to ask and find out what the five top things to watch out for in Budget 2018 will be. And number one on that list will be fiscal deficit. Has the government been fiscally prudent this year, or will it give in to populism? Remember, revenues have been tepid. GST collections are on for only 11 months. The government has had a tough time even with crude oil prices that are rising. And so many people believe the government will give itself some elbow room and let that 3.2% targeted figure of fiscal deficit expand in quest of growth and higher investments. Because remember, the GST has been rolled out and that is a disruptive structural reform. But 3.2% figure and where that figure really ends up for fiscal year 18 is the big question. If it ends up at 3.2 or lower, the government has been fiscally prudent. If not, it will be pulled up on that count. The second very important figure that the markets, investors and everybody else will be keeping a very close eye on is what is the government planning to do as far as rural spend is concerned. The agrarian crisis is very deep, it's very acute. Everybody knows about the farming crisis, everybody knows about farmers committing suicide. 1.8 lakh crore is what the government had spent last year. Will capital allocations be higher this year, and how will they be different? How will they incentivize states to also come on board? How will they incentivize greater productivity in India's agricultural fields is really the big question, and the figure of rural outlay will be very closely watched as far as Budget 2018 is concerned. The third important figure and the third important fact that everybody will be keeping a very close eye on will be corporate tax cuts, if at all they will keep coming. Remember, in 2015, Finance Minister Jaitley had intended to reduce the burden for corporate India by slashing rates by about 5 percentage points to 25%. He did do that for small businesses with turnover of just 50 crore rupees. But the large kitty of corporate tax collection actually comes from businesses that have turnover of over 500 crore rupees. 54% of all the collection really comes from these guys, and they are the big guns who are waiting for some sort of respite. This will be his last chance. Will he walk the talk is really the big question. 2.5% figure as a tax rate cut is doing the rounds for a while now. Next, and number 4, will be the dreaded acronym of LTCG, the long-term capital gains tax on Indian equities. Prime Minister Modi made his intention and mind very clear when he said that Indian markets haven't really contributed to tax collection, haven't contributed to nation's growth as much as they ought to, as much as they warrant to, and which is why people are keeping a very close eye on what the government does with the long-term capital gains tax, whether it will be levied on equities, whether it will be brought at par with debt, which is 3 years from the existing 1-year period. So those are really the big questions, and that's the big concern that the street is going to be watching out for. Last but not the least will be divestment, selling non-core assets. It will be very, very keen to observe here that the government in almost over 2 decades will will overshoot its divestment target. It was supposed to garner about 72,500 crore rupees, could do upwards of 90,000 crore rupees. But how is that money coming in? Is that coming in on account of the ONGC, HPCL kind of deals? What proceeds will be used from divestment? Will it be used to create assets? Will Air India privatization feature as the divestment plan for next year? I think markets are going to be keeping a very, very close eye on that. So if I may quickly recall, the 5 big things that the markets will be watching out for will be fiscal deficit, rural spend, government's action on corporate tax, LTCG, and of course the divestment figure.